Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Earnings season is in full swing as companies report their latest results, and we are covering the good, the bad, and the ugly. Mr. Beat Up is back with a stock primed for a turnaround, and we are answering a community question around some of Australia's favourite listed investment companies. Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. As always, I am excited. As you said in your intro, we are right in the middle of earnings season. There's so much information being released, a veritable fire hose of information, and we're going to distill it all into a nice meandering stream for people to drink from. Big episode. Let's get into it.
News and markets.
So earnings headlines we're going to cover today. The good news is that earnings keep surprising. It's been a bad day for Novo Nordisk, and the ugly, the car industry is getting pumped. Ren, let's start with the good.
Yes, always start with the positive news, start with the good. And look, earnings season as a whole has been pretty positive. So right now we're about halfway through America's Q2 earnings season. In America, they report results quarterly, so every 3 months. So we're really learning about the period from April to June in America. As soon as this finishes, we then get into Australia's half-yearly reporting season. So the information doesn't stop. But if we focus on America for now, because that's where most of the results are coming out, this data comes from FactSet. So 34% of the companies in the S&P 500 have reported results. Mm-hmm. And this is a few days old because we're now ticking up towards half. But 34% of the companies had reported. Of those companies, 80% reported earnings above estimates.
Okay.
So they beat Wall Street expectations.
That's good.
But, let's not worry about estimates. Are these companies actually growing? That's really the question that you want to know.
The counter argument, Ren, could be that Wall Street's expectations for this period were really low.
Yeah, well, let me give you the actual numbers. So year over year, profit or earnings grew 6.4% across the companies that have reported. So not bad. That's beating inflation. Mm-hmm. Now, look, it is lower than the last quarter where it was around 9%. It's actually the lowest number since Q1 2024. All right. So that's like 5 quarters ago. That's not that long ago. Yeah. Profits are growing. It's not a number that will blow your socks off, 6.4%, but you compound 6.4% for 30 years and you've built you've built a nice little nest egg there. But we're starting with the good, and there have been some companies that have blown that 6.4% out of the water. All right. Let's start with big tech, because big tech keeps getting bigger. The results are pretty incredible. So let's start with Meta. Shares jumped 10% after it reported. The reason why, revenue was up 22%. Profit was up 36%. Yeah. These are companies growing off a massive bases. Microsoft shares jumped 9% after it reported. The market loved it because revenue was up 18%, profit was up 24%. Alphabet, the parent company of Google, reported revenue up 14%, profit up 19%. So all these massive trillion-dollar tech companies growing at double digits, both revenue and profit. All 3 of them profit growing faster than revenue, which is notable as well. And if you look at Microsoft and Alphabet's results, the thing that stands out is their data center business. So Google Cloud and Microsoft Azure. Incredible sets of results.
What, Meta's not an incredible set of results? Or you mean specifically on
no,
cloud?
I mean Meta doesn't have that. They're building a data center, but they don't have like a cloud business in the same way. Yeah.
Love it.
Yeah, I mean Meta's result was the best of them. But look, as we close out the good, one other highlight from me, Mr. Beat Up's going to join us soon. Yes, so we got to give him his flowers, keep people listening for that Mr. Beat Up segment. He came on about 6 months ago and said Boeing was primed for a turnaround. turnaround.
He did.
Or maybe a bit longer than 6 months ago now.
Yeah.
Since that episode, Boeing's up 49%.
Nice.
So well done, Mr. Beat Up. Boeing's report was pretty good. They delivered 150 commercial aircraft in Q2, up 63% year on year. Revenue was up 35% to $22.7 billion. The aircraft maker's still unprofitable, so it wasn't all good news. But here's the number that just knocks your socks off. Their aircraft order backlog is up over $600 billion in orders. It's like 10 or 11 years worth
Surely
or
they
something.
stop taking orders at some point just to clear the backlog. Clear the backlog.
Well, this is what happens when you've got a duopoly provider.
Yeah, it's just sit in line, boys and girls.
Yeah, it's just nuts.
And to close out the good, Ren, moving over to Australia, some awesome news for the shareholders of Drone Shield.
Yeah,
Huge news.
We're not in Aussie reporting season yet, but Drone Shield jumped the gun early. And why wouldn't you when you have numbers like this to report? Q2 revenue up 480% year on year.
Yeah, well, I think we spoke recently about they signed a contract. In one contract signing, they had brought in more revenue than in their entire previous financial year.
Yeah.
So no surprises there.
Yeah. All right. So that's some of the good news. We'll keep you posted. And if you do want to keep up to date day to day, the Equity Mates Daily News email is the place to stay up to date. But Bryce, hit us with the bad.
Bad news. Bad news for Novo Nordisk. What was once the largest company in Europe, it's now seeing a pretty significant fall from grace. So last week, the stock plummeted 23% in one day after they came out with a downgrade to their forecast, both revenue and profit forecasts. It's the second downgrade that they had in the space of 12 months. So obviously shareholders not liking that. It wiped $70 billion from their market cap. To put some numbers to it, they'd previously forecast sales growth of between 13 and 21%. They've downgraded that to 8 to 15%. So at its worst case, almost half. Now, the question is why. The company spent a lot of time in their earnings report talking about the impact of persistent competition from unauthorized compound versions. So you think your Hims and Hers and these companies that are creating sort of compound versions of their Wegovy weight loss drug. However, I think the real reason that Wall Street didn't like this is because for the first time they are no longer the market leader. Eli Lilly has actually overtaken them as the market leader in this space. So they didn't mention Eli Lilly once in their shareholder earnings call. They mentioned compound competitors 69 times. So it's been a massive fall from grace, Ren. As I said, they were once the largest company in Europe, worth $600 billion, 12th most valuable company in the world, but now they're currently worth $240 billion. So bad day for Novo.
It's a real lesson in expectations game. Like the expectations for these weight loss drugs is so high and there's so much expectation built into the price, even though Novo is now trading on like a 14 times price to earnings ratio. But just to provide some balance to this story, let me give you the year-on-year growth for, I've got it going back, everything's above 20%. Actually, the last quarter was 19.5%. But the last year, 25%, 21%, 30%, 20%. It's like those numbers are... That's incredible growth still. It's just it's expectation.
Slowing. And I guess it's all relative though. Like they're losing to their major competitor now.
Yeah, exactly. Well, that's the thing. They're losing market share.
Losing market share. The doctors aren't using them anymore.
Well, no, that's not true. The bull case, like clearly doctors are using them. It's just...
But less and less now. Like...
More and more,
I reckon
but
you'll
on
see
a
those
relative
numbers
basis.
Continue to slow.
The big question for Novo shareholders is a lot of Hims compounding is pretty rudimentary. It's like, oh, we'll add vitamin B12 to it and therefore it's a compounded drug. And so they're suing in America to try and stop that.
Yeah.
The outcome of that lawsuit is going to be really the thing that a lot of Novo theses depend on. Is that the plural? Theses?
Theses, yeah.
Theses, yeah.
I think, though, they do have a fundamental problem that they just still don't have the best drug as well. Even if they can stop other compounders. Eli's now starting to really take over just from a comparison of them v. Wegovy.
Yeah, well, you're obviously an Eli shareholder. I own both, so I think I'm...
I mean, the proof is in the pudding at the moment.
Well,
They're getting beaten.
Yeah, a lot of companies would kill for that growth rate. There's clearly a big enough market for multiple winners. The question is just, will they be one?
No. Let's close out with a What The segment of the email where we bring some surprising stories to our newsletter. If you're not subscribed, there'll be a link in the show note. But Ren, the ugly is around the impacts of tariffs, and we're starting to see it come through in multiple industries, particularly the car industry.
Yeah, I think, the car industry, that's been the theme of reporting season, is just how much they're getting hit. So just to run down the list of some of the commentary we've seen, Ford expects to pay $2 billion in tariffs this year. Stellantis, which makes Chrysler and Jeep, they expect to pay $1.7 billion in tariffs this year. Volkswagen, the European car maker, they have paid $1.5 billion already in the first 6 months of this year. General Motors projected that they could pay as much as $5 billion this year for tariffs. So, a lot of industries are talking about tariffs, but the fact that the car industry has tariffs on their finished products, cars, but also on their inputs, steel, they're really seeing the impact of these tariffs come through.
Yeah. Just to close that out, not the only industry. Procter & Gamble, one of the world's largest, consumables retail conglomerates, has come out to say that they expect a $1 billion hit to their cost line in their most recent fiscal year. The impact of this across the company is they're going to increase prices to 25% of their range.
Wow.
Which for a lot of everyday Australians and Americans is going to hit the back pocket.
All right, well, if you want to keep up with earnings season, sign up to the Equity Mates Daily News email. We're going to be back with one of our favourite segments, Mr. Beat Up.
Mr. Beat up. Mr. Beat Up.
I have the beat that describes that moment accurately.
Lawsuits, ransomware attacks, media pylons, and a CEO assassination. Today, Mr. Beat Up is back, and we are looking at one of the world's biggest companies that is in absolute chaos. Mr. Beat Up, Simon, welcome.
What an entry. Good to be here.
Well, there's not a lot of mystery, Simon, around which company we're talking about. Lawsuits, ransomware attacks, media pylons. Could have spoken about a number of companies, but CEO assassinations. Today, you're going to be talking us through United Healthcare.
Yes. They trade on the New York Stock Exchange, ticker UNH. Today's the 31st of July, currently trading at $265 a share. They're down 57% from their all-time highs of around 625, but that actually equates to about $300 billion worth of market cap. So probably one of the biggest falls in history.
In history?
Wow, no.
Now, if you've just joined the show for the first time, the reason we are bringing this stock is because Mr. Beat Up tries to find stocks that may be beaten down but not out, where the market has overreacted to some news. So today we're going to find out if that is the case with United Healthcare.
And to give you a sense of some of the companies we've spoken about, Tesla, Nike, Boeing, Coinbase, Supermicro Computer, we've been tracking his results since he started for a little over 12 months. Weighted average return is 59.9%.
Wow. So almost as good as your annual return, right?
So, Simon, where do you want to start with United Healthcare?
Yeah, so I think probably just run through the last 12 to 18 months. That has been pretty chaotic. Probably kicked off in Feb 24. There was a ransomware attack. Their claims processing completely grinded to a halt. Pharmacies were actually faxing prescriptions, and apparently they end up paying $22 million in Bitcoin to get through this attack.
I did not know that.
Then fast forwarded to December last year, their insurance arm CEO, Brian Thompson, he was actually assassinated in Manhattan. So, but then in this year, the financial fallout really started to begin. In April, they missed earnings. It was actually the first time in over a decade they'd missed earnings. The stock dropped 22% on that day. And then the next month, the CEO, Andrew Whitty, he resigned abruptly for personal reasons.
We should just clarify because people get confused by that. The CEO that was assassinated was like a CEO of a subsidiary.
Yes.
And that's why.
Insurance.
Yeah, that's right. Yeah.
So then the big dog CEO resigned.
Then the big dog, he resigned for personal reasons. The next month, the Wall Street Journal came out and said that the US Department of Justice had a criminal investigation ongoing to United Health's Medicare Advantage billing practices. They then brought in a former CEO to lead the group. Stephen Hemsley, he'd run the company for 7 years from 2006 to 2013. And then this week, they reported and missed earnings again.
Jeez. So a lot going on in there. A bit of a wild ride. The question really, though, about this segment is, has the market overreacted? Because it feels like there's a lot of things in there that would warrant the reaction from the market.
Yeah. I don't think it's completely, but it has still got a strong pulse, but I think it's going to be a long recovery potentially. I've done some homework.
Okay.
I've used the 4-step checklist to analyze any stock again.
Yeah.
Nice. Which is downloadable in the show notes or YouTube description.
Yeah, I thought it was a good way to frame this. So, should we crack in and go for each of the steps?
Let's do it.
Step 1, does the company make a great product or service?
Yeah, so this one here is like, are customers actually willing to pay for it? Is it a good service? Like, I think here, I'm not sure about willing to pay for it, but people are paying for it. It's the backbone of American healthcare. Largest insurer, health insurer, largest care delivery, largest pharmacy benefit network. And they have all the tech and data stack to put together. So I guess the way to think about it is they don't just insure people, they run the doctor's office, they fill prescriptions, and they actually process your hospital bill at the end.
Yeah, you can't say American health insurers make a great product or service. What you can say is that they find a way to extract every dollar from the people's need for healthcare, and it's backed up in their revenue numbers. You know, like they're a giant company, and you just look really since Obamacare in 2010, they're up 1,500% before this big fall. So they've been a big winner. But even just more recently, $290 billion in revenue in 2021 to over $400 billion of revenue today. Like, that's a big jump off a big base already.
Yeah. So the revenue's there. They're still growing sort of low double digits most years. So people might hate the system, but they still have to use it. And United Healthcare are the ones they're using.
Yeah. Well, then point number 2 is around making profit from their position in the market. Do they have a sustainable competitive advantage?
Yeah, so their big advantage is that vertical integration. So most insurers, they actually pay out to external providers, but they just pay their own providers. So they're getting margin and profit throughout the whole of the value chain. Morningstar rate it as a narrow economic moat. So I think the way to think about this is they got like a decent fence around their castle, but it's not completely impenetrable.
Okay.
But they're actually starting to struggle to convert that revenue to high profit. And this is where some of the kind of negatives coming in. So they adjusted their earnings this quarter to $4.08 a share. The market expected $4.48. And their profit fell actually 19%, even though revenues rose 13% year on year. So they're having cost issues, and also there's more competition coming. We spoke about it on X Marks the Stock segment last week. Companies like Oscar Health, they're trying to disrupt this space.
Big time. Okay, so for point number 2, will they continue to earn above market profits? Is it a pass? What do you think?
Like, I'm going to give it a pass just for that moat they've got, but it's a watch out.
Okay, nice. Step number 3, then, can they take that profit and reinvest the profit productively?
Yeah, so this one, looking at a couple of metrics that is advised on the 4-step checklist, like return on equity, 15 to 25%. When 15% we say is hurdle, so ticks there. Return on invested capital, they're around 10%. The hurdle's 10%. So they're doing okay here. They've done a bit of M&A activity. They're trying to continue to acquire more practices, clinics and services. And they've got a venture funding arm that they invest in tech startups. So yeah, I think they're doing okay. Again, probably just a pass on this one, I'd say.
Alrighty. Okay. Step number 4 then, final one. Can it be bought at a reasonable price? Is the available price going to allow you to make money? This is where Mr. Beat Up really comes into play.
Yeah, look, I think there's enough here to suggest it's a decent entry point. You know, I'm a big fan of price to earnings ratio.
Yeah.
Last 10 years, they've been around 22. They're currently 11 or 12.
Okay.
PEG ratio is another one you guys recommend looking at. They're about, if you look at the forward earnings, they're about 1.32. So that doesn't suggest they're super cheap, but it's around that 1 where things start looking attractive. What's interesting, I saw this stat that apparently insiders have bought more stock, so directors and leading management team have bought more UNH stock in this year than the last 18 years combined.
What?
Wow.
So what are they?
What's going on there?
They're trying to give the market an indication that they believe it's undervalued. Another one I saw flash up was Congress. purchases.
Yeah.
There's been more positive purchases than negative sells for the last 5 years. So so that's interesting.
So yeah, it is an interesting one. I think it's worth calling out that United Healthcare's price to earnings, you said, is about 12, which is lower than historic. But health insurers don't trade at a crazy price to earnings, so it's like a little bit below the market. Some of the other big ones in America, Cigna's trading at 16, Humana's trading at 18. So there was probably a little bit of mean reversion and then it kept falling a bit.
Yeah.
My big question is catalyst though.
Yeah.
It's like what's going to change here?
Yeah, spot on. I think for me, this is one where there's no obvious catalyst where this is suddenly going to bounce. I think it's going to be dependent on the coming quarterly earnings and the CEO actually starting to turn things around. So some people are saying that he threw the kitchen sink at the last one where, it's his first quarter, get all the bad,
Get it out.
And then he can start beating. So I think that's the thing to watch out for. I don't think there's anything going to really happen. It's suddenly going to bounce. Keep an eye on those quarterly reportings. And if things start to turn.
So tactically, are you putting this in the Mr. Beat Up portfolio?
No, you pitched it. You have to put it in.
It has to go in if it comes in.
I don't know. You're the owner of it.
Get it in.
Really? Yeah. Get it in.
I reckon the one thing to just watch is there's potential negative catalysts for the health insurance industry more generally as well. Like Obamacare subsidies are being removed and, you see a lot of these health insurers have really ridden the last 15-year wave of government money in health insurance. So there could be more negative earnings to come as well.
It wouldn't surprise if it shifts down another 10, 20%.
Yeah.
Don't put it in then.
Yeah,
Don't put it in.
I thought it has to go.
No, I guess it doesn't have to.
Maybe
we can do
put it
the
on the
process.
watch list. Put it on the watch list.
Yeah, we can do the process and say it's beaten up, but it's not a turnaround story.
Yeah, I think this will be the first one where I'm like, let's hold on it. Let's give it a hold.
Doesn't excite me like the other ones.
It doesn't excite me, like Coinbase, Supermicro. They're exciting.
But if it bounces,
Tesla,
you don't get to
Nike.
claim it.
Okay, next time I come in for so we'll do next Mr. Beat Up. We'll do a review.
Next
if it
earnings.
goes in.
That's when you're looking for.
Next earnings.
Nah, come back with the sexier one next, Mr. Beat Up.
We'll come up with something good.
I love it. Well, as always, if you have a stock for Mr. Beat Up to have a look at that you think is down but not out, then head to equitymates.com/contact, leave us a voicemail, or you can write to us, hit us up on our socials, or join us in our Facebook discussion group. But Simon, thank you so much as always.
Thank you.
We're going to take a quick break, and on the other side, we're answering a question around some of Australia's favourite listed investment companies. We'll be right back. Welcome back to Equity Mates. We love getting questions from you, and today's question comes from Chris.
Hey guys, just wanted to get your thoughts on low management cost listed investment companies like Argo or AFI. Do you think they're a good option, or would you rather see those investments going into market tracking ETFs like VAS? Cheers.
I love the question, Chris. Thanks for recording the voice note. Remember, you can record a voice note at equitymates.com/contact. The reason I love the question is because my co-host here has strong feelings about listed investment companies. So we're going to hold him back for a second, and we're just going to explain what they are and how they differ from ETFs, and then we can get into what we think about them. So very quickly, listed investment companies, or LICs, and then exchange traded funds, or ETFs. In many ways, they're very similar. They allow us as investors to put our money with fund managers that go and then invest that money on our behalf. They are traded on the share market, and so you can buy and sell whenever the share market's open, and they have daily liquidity and a daily price. So you can, what your holding's worth, and you can buy or sell at any time. The key difference is how that price is set. So with an ETF, the ETF price will match the underlying assets that it's investing in. And the reason that is the case is because the ETF provider, if you buy, they will create units for you to own. And if you sell, they will destroy those units when you sell. And so they make sure that supply and demand always match up. And that's because it's called an open-ended fund. The key thing you need to understand, you don't need to understand the mechanics. What you need to understand is that the ETF price will match the asset value. That's different with listed investment companies. Listed investment companies have a fixed number of shares available, and as you're buying and selling them, that's what sets the price, similar to a share price of a company, rather than what's actually held in the underlying fund. And so you'll often get a discount to between the share price and the assets that the fund holds, sometimes you might get a premium. And the price moves a bit differently because it's a close-ended fund.
Yeah.
But let's actually answer Chris's question, which is, what do we think about some of these low-cost listed investment companies? They're pretty big, like Argo, Australian Financial Foundation Investments, AFI.
And they're big because historically this was the ETF equivalent, really, for the mums and dads. Yeah, boomer ETFs. These were the equivalents of ETFs, 20 years ago for everyday retail investors to get access to diversified portfolios.
So today we have a choice. So how do we answer the question around that choice?
So there's two parts to it. Firstly, it's looking at how active managers compare to the index. And then the second is then how ETFs compare to listed investment companies to decide really where we should be putting our money. So let's take a look at active management versus the index.
Because in this case, Argo and AFI are active managers.
Yes. Yeah. So the three options mentioned in Chris's question were the Australian Foundation Investment, AFI, and Argo Investments. So AFI is up 20% over the past 5 years, and Argo Investments is up 25% over the past 5 years. Now, Ren, if we're to compare that to VAS, the Vanguard Australian Shares Index, it's up 43% over the past 5 years. So
those numbers are all before dividends, but all three of them are paying decent dividend yields. So once again, the takeaway is the same. We might sound like a broken record here, but it is an inescapable conclusion. The index is powerful, and it's very hard for active managers or individual investors to beat the index.
Yes. Yeah, enough said. Second is then comparing the ETF, mechanism to the LIC mechanism.
Let me set the scene, and then we'll just let you tee off. So I mentioned earlier that the LICs can trade at a discount to the assets that are held in the fund. And so AFI, their share price at time of recording, $7.56. The assets per share, $8.42. So there's a 10% discount to net asset value. Similarly, Argo, $9.19 share price, $10.72 asset value per share, a 14% discount to net asset value. Now, you might be asking, why is that a problem? And the reason that can become a problem is there can be times with LICs where the fund manager's killing it. Fund manager might be returning 10% a year, doing everything, or 10% a year is not killing it, but returning 15% a year, absolutely killing it. But the share price doesn't move because no one wants to buy these LIC shares. And so all that happens is the discount gets bigger and the fund manager's doing great, but you as the shareholder aren't seeing any benefit.
Yeah.
So with that explanation, Bryce, why don't you...
Well, I mean, you've kind of alluded to it there. The difference, and where people, I think, get not confused but excited in a way, is they fall into this discount trap where they say, oh my God, there's a 14% discount to the underlying assets. I can buy, $1 worth for 86 cents. This is a good deal. But I think the second part is that LICs, for me, are just a marketing game. You're not actually investing in the underlying assets and letting the assets do the job for you like you do with an ETF. You are effectively making a bet that the manager that you have invested in is going to go out there, market themselves well enough so that people buy the stock. Because at the end of the day, the stock price is driven by the supply and demand of that stock price, not by the underlying assets and performance of the fund manager. And so you could have the best performing fund manager, as Ren said, sitting in a corner somewhere, absolutely killing it. But if no one knows about this person and there's no liquidity in the stock price is not going to move. On the other hand, you look at some of the best performing, and I say performing, listed investment companies, and those that are trading closer or at a premium, and it's because they have epic marketing teams. So I think fundamentally, those that are going out there talking about their products, getting in front of investors, getting liquidity into their share registry, they are the ones that are performing it. For me, it just has nothing to do with the underlying performance of the manager.
Do you want to name names?
I mean, credit where credit's due. Jeff Wilson and Wilson Asset Management do very well at this. They have a listed all of their products, not all of them, but a lot of their products are listed investment companies, and they often trade at or above net asset value, like at a premium. And that's because Jeff has realised that getting out on the bike and going around Australia and talking to shareholders time and time again gets people excited about his products.
Yeah, I mean,
and
like,
so people invest in it.
He's so against the discounts that you see in listed investment companies that he launched his Strategic Value LIC, which declares war on discounts.
But he knows the recipe.
That, it's recognizing the fundamental problem with the structure.
Exactly.
Because here's the thing. They built a better mousetrap. ETFs are just a better version of LICs for the individual investor.
Yeah.
Arguably, they're a worse version for the fund manager because the fund manager loses liquidity when the market falls. But that's a separate conversation. There's heaps of active managers out there that have active ETFs.
Yeah.
That would be my takeaway.
Me too. Yeah. ETFs over LICs. Enough said.
Come at us.
Come at us. Thanks.
If you disagree, Facebook discussion group is the place to have it out.
Love your question. Thank you, Chris. If you'd like to ask a question just like Chris did, leave us a voicemail. Head to equitymates.com/contact. If you enjoy listening to us and you take a lot of value from our show, there's two things that you could do that would really help us. A, share this episode with a friend or a family member. And B, take 10 seconds to rate and review in your podcast app or leave a comment and subscribe if you're watching us on YouTube. We love hearing from you. But Ren, that does it for today. We'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.